Do is really kind of lay out some of the landscape on early stage venture capital, because much like the debt and loan market, it's vast, and people may talk about it, but it means different things to different people. So what I thought I'd do is first, who are the people that are investing in venture capital? Well, most people think about institutions. So these are venture capital firms. They've gone out and raised a fund, and they put those funds in specific companies. Now, and especially at the early stage, you're seeing much more individuals making those investments in early stage, and they are referred to as angel investors. So they are investing in equity, and they're individuals. And then you have this sort of new category, super angels, often which are part of family offices, and they're almost hybrids between individuals and institutions in that they can write 6, sometimes 7-figure checks, and they can play a much larger role, but they don't have they're not a specific institution. And as Lauren mentioned before, strategic partners. And we've certainly seen at Branch where food companies and corporations are really hungry, sorry for the pun, to get involved with novel, innovative companies. So we're seeing strategic partnerships much earlier in the life cycle of a company than in other areas of the venture capital landscape. So that's the who. The what. Venture capital is equity-based, and it goes by names like Series Seed or Series A. In some cases, when you're very early, it will often present as a convertible note. This is a note that earns interest, but it will convert to equity at some point in the future. And the reason for those notes is doing an equity-based financing these days probably costs $50,000. So unless you're raising substantial amount of money, it really doesn't make sense to spend that much on lawyers. And convertible notes, on the other hand, are very inexpensive, often just several thousand. And there's something even easier than convertible notes. And these are known as SAFEs, which stands for a simple agreement for equity. And it's, I give you money, entrepreneur, and at some point you're going to give me equity, but the price yet to be determined. Often both convertible notes and SAFE will have caps, so the price won't get above a certain level. But that's sort of the types of terms. And in the Q&A, happy to go into more. So why take venture capital? Well, A, it's not debt. You don't have to pay it back until there's a liquidity event, which is great for a business if you can get it. You often gain expertise at no cost to the company. The investors who want to come in and take ownership generally know something about your business or your target market or how to grow companies, or at least they should before you take their money. So there's some expertise. You often get to access that amazing network, and you can really set the company up for success, really leveraging your time and capabilities with other experienced people. Well, why wouldn't you do it? That all sounds great. It can be very complicated, and it's often expensive. And I think a lot of entrepreneurs, they may get the expense, but they don't really think about the complication. You are taking on an owner. If you think of debt like an Uber ride, I book it, at the end, I'm going to have to pay something. This is more like a relationship or a marriage. You're signing a marriage license, and you got to go through a lot to get there. So you're really integrating yourself with the investor. You may risk your role at a company. Often investors want to have the right to appoint a CEO of the company. If that ends up not being you, you could be out. So thinking about the role and where you are. You also have to have and develop a pretty active and clear long-term planning objective. If you're early on, not exactly sure where you want to go, venture capital is probably not for you. And most important, and it's one of the things we talk a lot about, is interpersonal chemistry. They're fantastic investors and they're fantastic entrepreneurs. But if the investor you meet, you don't get along with, or vice versa, do not move forward. And this is, again, much more akin to a long-term relationship, and you better be comfortable and open. Next slide. So for the emerging companies, so how do you know if you're ready for venture capital? A couple things that I think really important. Do you understand and have you identified the key risks in the business? Because that's where venture capitalists, either institutional angels, really going to focus on. So if you're still trying to figure out what those are, you may want to look for another source. Um, are you growth oriented? Is there going to be some kind of hockey stick? The role of a venture capitalist is to give you money, but they want more money back, which means you have to have a business that's going to grow and deliver often, 3, 5, 8x their investment returns, depending on the venture capitalists and their needs. Do you understand where you're going to be in 5 years, back to having a long-term vision? And why do you think you can get there? How do you know you're going to overcome those risks that we talked about? And then do you understand how much investment and time is needed to reach cash flow break-even operations? Something all venture capitalists really want to focus on, because that's one of the biggest risks, how much capital you need. And lastly, do you have a team? Most venture capitalists, angels, institutions, and corporates really want to invest in a team, not a single entrepreneur. They want to know you have the capability of recruiting and building a team. And then lastly, what are your own personal goals? If they're not to get on this rocket ship of growth, build a big team, really accomplish a lot, there are other ways to raise money. Venture capitalists may not be for you. And what are the risks? Well, you're going to give up some ownership, and that's some control. There will be a liquidity event in 5 to 7 years. There will be a sale. And this is something a lot of entrepreneurs don't really focus on. But once they take venture capital, the venture capitalists are going to say, who do we selling to? And all of a sudden, wait a minute, I'm building this great business, something I want to do for the rest of my life, and I'm going to sell to somebody else. How does that sit with you? So important to be aware of that. As I mentioned, there are job security risks that come up. And this is something most first-time entrepreneurs, when they work with venture capitalists, say, what bothered you the most? It's time consuming. And you're spending a lot of time educating your investors in what you're doing and why you think you're going to be successful. And that can seem very unproductive if you don't reach conclusion to get in the capital. Next slide. So what's my advice as we're sitting here and you're thinking about all the ways you could finance the business? First of all, turn tables on that education. Get an education yourself. It's a free education, talking to industry knowledgeable VCs and angels, and listen and learn. Go say, hey, is this business look attractive to you? What would I need to achieve before it would? Understand, and it's terrific, and it's totally free. As I said, chemistry matters. If that spidey sense says, maybe I don't want to sit in a small room, running through financial statements with this person, maybe move on. There is absolutely no harm in talking to venture capitalists early in your company development. They'll remember what you said, and especially if you do it. I think a lot of people hold back thinking, well, if I get rejected, will they talk to me again? Absolutely, especially if when you talk to them again, you've continued to grow, develop, and have a stronger view for how you're going to grow in the future. Important that a lot of entrepreneurs, and we see at Branch, and it does matter. Keep in touch. If you get a no, I always like this Louis Pasteur quote, chance favors the prepared mind. Even if you get a no, drop a line to the investor you saw and said, hey, appreciate the time. We've introduced a new flavor. We've opened more doors. We're moving in this way. We've improved our margin, whatever kind of issues, just let them know you're still out there working. That does matter. And it means, you listened and you were thoughtful. The other thing is venture capital does not mean you'll be a success, and not raising venture capital means you won't be a success. There are many successful companies that didn't raise venture capital. So if it works for you and it fits the mold, go for it. If it doesn't, you can find other ways. But that said, most successful companies have gotten venture capital. They have gotten this expertise. They have grown, they've accessed this network. They've really been able to achieve a lot financially. And I heard a quote earlier today in a phone call, which to me, if, to all the entrepreneurs on the call, resonated with me. It's apparently it's a Navy SEALs motto that the only easy day was yesterday. So each day it's, in this world of starting a company is hard, but you will make progress. So with that, I think there's my contact on the next slide, and I'll turn it over to our next speaker.